Hello everyone, welcome to Fearfully Greedy. In today's video I will cover Fidelis, which is the latest addition to the portfolio. If you don't know why, well, I will tell you why in the video. It will be more like an idea summary more than an investment thesis, so I will try to go more to the point, bring you some interesting maybe thoughts, and then you should do your research. Remember, these and all my videos are not to be considered financial advice. Please consult a professional or do your own research before investing, because I'm certainly not your financial advisor. Also, I do hold a position in this stock, so take that into consideration. I'm very biased, okay? So if you have not watched my previous video, do that, because I did research on all the 126, well, there's more, but 126 global public traded companies, insurance companies, and I kind of ranked them on like profitability, scale, size, a bit on also cheapness. I tried to add some valuation, and Fidelis came right on top. So I thought it was, to my analysis, the cheapest one I could find, with quality taken into account. Okay, ticker FIHL in the New York Stock Exchange. This company is based in Bermuda. Okay, a lot of insurance is based in Bermuda, so that's another thing. But they are mostly based, like they're insuring, they do mostly in the UK, that kind of part of the world. They do geopolitical insurance, so a bit everywhere, but mostly UK, that part of the world. Okay. Okay, what it is? They are mostly specialty, okay, but a bit of bespoke and a bit of reinsurance. Okay, their current gross premiums written, so GPW, it's 4.2 billion. Okay, they have a very good balance sheet. After looking into it, I didn't do that in the previous video, so I did that for this one. We won't go exactly into each line and their investments. Just so you know, it's net cash, and I think they are doing great things to get a bit better yield, but pretty safe, okay, on the investment side. Okay, what they have is very good return on equity, okay, so on average equity, while also having a very good like combined ratio. So I think they have done great things. It's run by pretty much very old school people from the UK market. And yeah, let's talk about that. The CEO at the moment is Daniel Burrows. Okay, he has 35 years of experience in the industry, and they are also. So Daniel will be more like on the balance sheet, and what we'll talk about today is Fidelis Insurance Group. Not to complicate it too much, but last year they kind of split up. So the balance sheet went one way, which is where I invested, and the partnership who does all the underwriting went like a separate way. Kind of they separated the companies, but they linked them together with an agreement. Okay, we'll see that. We cannot talk about Fidelis Insurance Group even without talking about Richard Brindle. Richard Brindle is like a legend in that kind of market, in the Lloyd's market, with many years on the different syndicates and different companies, but it's kind of like the guy that has gotten best combined ratios for the last 35 years. So pretty much a legend. Let's see a bit of that, how they do it. They say that mainly they have their know-how. They also talk a lot about being there, being in the office, being quick on the phone, and just when someone needs a risk taken care of, they can be there and they can price it. Maybe you don't like the price because they liked their combined ratio, so they want to get paid, of course, but they are there and they are very quick, right? And that's what they say, right? Here they have their integrated solution, where the typical insurer has many different solutions around, and they have to kind of go from here to there, and it's not very seamless, like the interaction. I have no idea, right? As I've never insured a thing in my life. Well, underwritten a thing in my life. Okay, if we take a look a bit on what they have done through the years, this 2021, okay, if we compare like their admin expense compared to Barclay, Lancashire, Markel, a lot of these guys, they are like, it's not like the cheapest, it's by a lot, right? If you see the kind of premiums written per head in millions, it's 4 times other people, right? So what I want to say with this is that their underwriting performance historically has been way above all their peers, right? The loss ratio, see, from 2017 to 2021 average, like it's 50% more on the on their peers. Okay, so their underwriting prowess it's very consistent. So I said they split up. So what comes to my head, the first thing I look is, well, what kind of agreement? Because if their main thing is their underwriting and they just split up the companies, what does that mean? Okay, if you see also the growth is pretty ridiculous. 2018 they had gross premiums written less, so 0.7 billions. Okay, but it doesn't say anywhere, but it's here billions. To current 4.2 billion. Third quarter TTM. Okay, so trailing 12 months. Return on average equity. That's a very important thing because mainly insurance businesses are valued by the book, and if you have very low returns on that book, you tend to pay a discount to book. If you tend to get high returns on book, then you pay premium to book. Okay, and there's if you saw on the previous video, there's some companies like this one, which to me makes no sense, but trading at 60-70% book, where others are trading at 2, 3, 4, 5 times. Okay, the best regarded in the world. Okay, but money is money, so we're after money here. Combined ratio, if you see there, 2018 to 2021, 23 in Fidelis, 85.8% average compared to 100% average. So the break even to all the peers, that group of peers. Okay. So okay, we want to tie that performance still to the company. So what they did is there was a separation transaction where FIHL and TFP Holdco, so the parent group, they have a lot of subsidiaries, which is what it's saying here, but FIHL will be like the provider of capacity, the book who's keeping all these premiums and these risks on the balance sheet, and then the Fidelis partnership can do their own thing. So they can keep underwriting, keep being flexible, keep being out there and quick on their feet, because that's what they need to do. Because what was happening is that an insurance company is very regulated. So you have to be in a lot of committees, sitting around, hearing a lot of people, regulation, waiting for that. Where if we separate the two, and one just gives some guidelines and follows all the regulations, but the others have to follow those guidelines, but they can be more creative on the other side. It makes a lot of more flexibility, and good underwriters doing good underwriting, and good money managers and risk managers doing that thing. Okay, not saying Richard is not good at both, but it's what I heard through the calls, interviews, and Dan, and I also think Dan is a great asset. Okay, but what has happened is that now we have what is called an insurance carrier, which would be Fidelis Insurance Group, which is the one I invested in, and then there's the partnership, which will be MGU, which is a private company. Okay. Okay, what they do is they do the underwriting, mostly managing all the claims, some other services. They sell and write the policies on behalf of Fidelis Insurance Group. They can do it for other parties, but Fidelis Insurance Group gets a first call on that. So they see the offer in a sense, and they are first call to that. Up to a limit, but both parties can do other things with other people too. Okay. Then those policies sit on the books of the Fidelis Insurance Group. Then they pay fees, which we'll see in a second, and every day they have a few daily meetings to address opportunities and risks, so they are very much together. They share a lot of information, they are partners in a way, but they have just separated the companies. Okay, they say it works for both companies beneficially. We'll see about that. I don't know until I see it, but I think they should. Most of their business will still be run by the Fidelis Partnership Group, and I think the combined ratio shouldn't change much. Okay, so it's a 10-year rolling framework agreement where there's a lot of fees involved, and I said first call, right? So if TFPs find something, they go first, like to FIHL can say pass or no pass, okay, but they also have their usual business. But it's like the relationship, even if now it's separated business, what they do together should be pretty much the same as before. You can see here this is a bit of a summary, okay, but there's this 10-year term. The renewals is on the year 1 and 3rd. There's termination provisions, like if results are not as they should. There's fraud, insolvency, so all of those things, okay. I said first access right on insurance group, and first refusal also. And TFP has the right of first offer also. So they have mutual access to first on each side, right? In a sense. So they want to keep working together, like it's beneficial to everyone. The ceding commission, if you see, it's around 11%, right? They also can do third party and bring it on. There's a portfolio managing fee just to manage risk, another thing, which is another 3%. There's some economic alignment, so return on equity, if it's over 20, if it's over 5, 20% of that goes back also to TFP. We just need to see for the new business what the final fee is, like what's the commission for all this underwriting thing. Like we have it written, but until it's not in ink, and until we see a few years out, we don't know if it's beneficial or not. The only thing beneficial, I think, for our business, for Fidelis Insurance Holdings, is that they have flexibility to go somewhere else also, right? Other than that, I don't see much of a benefit. For TFP, I see most of the benefit. Thinking about it, but the price is also so cheap that I think it makes sense, and I think actually think the combined ratio shouldn't get hurt a lot here. So let's take a look into that. So the Fidelis partnership commissions for the 3 and 9 months have been, well, this 97 and 249 million, which is 15.3 and 15.3% of the combined ratio, okay, respectively. I did, so that's what they say, okay? I don't care what they say. Let's do it ourselves. So I did the loss ratio, expense ratio, my expense ratio, which is all expenses, and then the combined ratio. All expenses minus the losses and loss adjustment. And we can see that 9 months last year was 38.5, 9 months this year 39.6, 46.2 on the expense ratio, 51% this year. So it's a bit higher, but it could also be that the market has moved a bit. We need a few more years out to really see if there's a 1%, 2%, 3% difference. Worse, I think probably worse for FIHL, but we don't know yet. Still, these combined ratios are very competitive. If we compare to peers, they are still doing much better than them. Okay, so I think it's still a good agreement, and we should see good combine, good growth, also maybe some other opportunities that they have started to announce in the last year. But yeah, just if we compare the combined ratio, we were at close to 90, a bit over 90. They always say 80 something, 85 minus than 90. That's their range. Okay, that would still put you on this list, top 10 of the 126 companies in the world. So still a very good combined ratio. Remember, the average was 110 in the last 7 years. Okay, then another thing for FIHL is that they have done a very good thing on. So every year when there's risk, you kind of save some for what could happen for next development, for the risk that you're insuring, what could happen. And usually most companies from the reserve, they have to keep adding. What we see is that from 2016 to 2024, it's all taking out from that reserve. So they reserve more than they should That's a very, very good sign, okay? And I like it a lot. If I saw a report also on SP Global that they say that capitalization was redundant and 99.99% confidence level, and they expect to remain the same until 2026. Financial leverage was below 25%. Leverage was 17.4 at the end of 2023, and the fixed charge coverage was 12.3 times compared to 21.2 on the previous year and 4 times the prior year, respectively. So very good coverage. So I think the balance sheet is very safe. I don't have any worries on the balance sheet side for this company. I have more worries maybe on the underwriting and how that agreement kind of fluctuates, but the company's net cash. They also kind of buy a lot of reinsurance, so they are very safe people. I would say 35 years in the industry. It's not someone new that is trying to break things. Yeah, if we this is just kind of going over all the growth. So they grew from 0.7 billion to 3.6 billion at the end of December 31st. So on that year, the amount of trading 12 months is even over that. A compound annual growth rate of 38.9%, which I think it's a bit high. You have to know that they are in a bit on a frothy market, so the premiums have grown a lot and they could reprice a lot easy, which in the future might not be the case, but still we don't need this kind of growth for the valuation to make sense, as you will see in a second. Loss and combined ratio for the 3 months and 9 months is 37.85% compared to peers 60 and 91%. So the agreement is still showing superior returns to peers, okay? And remember, peers are not anyone else. It's Lancashire, Hamilton, it's Berkeley, Markel, so very good things. Same period, our combined ratio was 93, 91, 82 compared to 100, 96, 93. So always much lower. If we take the comparison, like the performance comparison, is way above everyone else. After following the separation, the partnership held like 10%. We have here all the investments also. Some of them are also linked to them. Also, they have been repurchasing shares and they are kind of offloading. So there was some alignment. The alignment is fizzing a bit away. So they just realized some cash on that. But yeah, the last numbers I know it's still 9.9%. But on the last report, they say that I think 6% of their buybacks were from Shelf Holdco. So they are unloading some, right? I think also Richard on a personal level owns some stock also, but I think the alignment is kind of going a bit away, which is my only worry. As I said, I'm repeating myself, but it's what I see. Then about Dan Burrows, I have listened to like 4 calls and also 3 interviews from Dan in a couple podcasts. And I think the guy is pretty good, so we'll see about it. Alan has been also in the calls. I think for someone that you want to run like a book insurer, he knows a bit what he's doing. Let's call it a bit. From 35 years of experience, very much superior return. So we'll see how that pans out. I took a look of everyone who was invested. I like to see that Omega Advisor is there. Lee Cooper is an investor also. Not anyone else I know, but it's funny to see the guy is 80 something and he was in the call, in one of the calls. He was asking questions still. So after that, what I will do is just keep my measuring stick, which I want to see mid to high 80s% on the underwriting profitability, combined ratios. I want to see operating return on average equity 13 to 15%. If they can keep on that, we should make a lot of money. So let's say it like that. But if they move a bit away after the framework, I might move away from the position also. If we take a look on the combined ratios, they are still very good. The operating return on average equity, this for the quarter, so keep in mind this for the quarter, around 10%, missing one quarter, so we should be around that. Those are crazy numbers. This is a bit on the summary. Price to book is 0.77, but they are net cash, so it's more like 0.7 at the moment. 70% of book we're paying. But the return is pretty ridiculous. We cannot see it there. Also keep in mind they have repurchased 100 million in stock, and they still have, so they had 200 plus 50, so 250, so we have 150 million to go. That's close to 10% also share buyback, but if they are still below book, I would encourage them to keep buying as much as possible. So I'm good on that. Not much else to say. Like, it's a pretty simple thesis. They are good underwriters. It's cheapest in the world, or one of the cheapest in the world from the good underwriters. And they are repurchasing shares. They have a lot of experience, superior returns. I don't know. Very safe book. Not much else to say. So what did they do? I added 10,000 euros on the 3rd of January to the project, okay, and 8,700 of those went to buying 500 shares of Fidelis Insurance Holdings Limited. The portfolio at the moment sits like this. On the 4th, Carvana first position, Playmates, Fidelis, Warrior, Naked, Pax, Baba, Nacorp, and Ray. At the moment, we are under attack, so there's been a Hindenburg short thesis, short position on Carvana, and it's been falling a lot. Okay, so yeah, if we added the 10,000 euros maybe 2 weeks ago, we would be at 110k. So we're 20k down, more or less, maybe 15k down on the previous, on this position alone, right? So in the last few weeks, few days, a week maybe, more or less. So the next video will probably be covering that short thesis, the short report on Carvana, and seeing what they think. Maybe they change my mind and I should sell all of it. Well, we'll think about that. Okay, well, thank you for watching. Subscribe if you like it, like the video if you liked it. I will see you in a few days, weeks, who knows. Bye bye, take care, be safe.